Welcome to the Building Web3 podcast. Today we're doing a deep dive with Lex, founder of Generative Ventures, who transitioned from Lehman Brothers to becoming the CMO of ConsenSys and later a financial entrepreneur. We'll explore his journey into Web3, the exciting intersection of blockchain, AI, and decentralized infrastructure. And remember, as always, nothing stated here is financial advice. Welcome to the Building Web3 podcast. Today, my good friend Lex. He is the founder of Generative Ventures. Lex, before we get too deep into Generative Ventures, could you give us a brief background into what you were doing before you got to Web3 and what was your come to crypto moment?
Ooh, okay. So I've transitioned to Web3 probably over the course of 15 years. I started my career on Wall Street with the Lehman Brothers bankruptcy. So I had the pleasure of that experience early on. And then I became a FinTech entrepreneur. So I worked on building out a robo-advisor and then a wealth tech platform in the early 2010s. That got me to thinking about the edge of innovation in financial services. And so I was kind of chasing the frontier for what was changing and what was interesting. So that kind of pulled me into neobanks, and I moved to London, where I started looking at the big platform shifts in finance in an equity research firm. And after that, I joined ConsenSys. So 2017, I saw the absolute explosion of creativity and interest on the Ethereum ecosystem. I started tracking it, spending a lot of time on it. And then 2019, I joined ConsenSys, where I did a bunch of things from running all of the digital asset and FinTech and DeFi projects, co-leading that on the product side. And then I was the CMO of ConsenSys for a while, and then the chief economist. So that was my core crypto experience. I was interested in Bitcoin. I bought my first Bitcoin, I think, in 2013, but I wasn't really motivated to work in the industry until Web3 came around, which I think is the most interesting part for me. And then over the last year, I co-founded a venture fund focused on the intersection of Web3, artificial intelligence, Deepin, decentralized physical infrastructure networks, and that's my focus.
Very cool. And now you said you were very interested in Web3. You bought your first Bitcoin, but it wasn't as enticing. Tell us what really excites you about the Web3 ecosystem and where you really see the future going there.
I think there's things get kind of really confusing and mushy because people can't tell apart financial products from fintech products from financial instruments. It all sort of sounds and is the same. So investing into Apple is not the same thing as owning an iPhone. And I would say most people are super confused. So they think they're buying an iPhone, but they're actually just holding Apple stock, and vice versa. And crypto kind of mushes things even more together. But what's possible in Web3 is the building of an economy that uses Web3's economic architecture to intermediate ownership, digital rights, and identity. So the ability to have something is really difficult to enforce in a digital environment. And so Bitcoin was the first digital asset that you could actually own, that if you had it, nobody else had it. And then if I transferred it to you, then you had it and I didn't. And that's sort of, in the physical world, is pretty easy, right? If I give you an apple, I don't have the apple anymore. I can't eat the apple I gave you. In the digital world, that's not easy. If I send you a PDF, both of us have the PDF. And so that digital scarcity is kind of the first step. But what Ethereum did, and what kind of I call Web3, is added programmability into an environment, into an economic architecture that allows for the ownership of assets that are natively digital. And so programmability means you can build anything. It doesn't mean you build finance or healthcare or science or media. It means you can build anything that you can think up. And that's what we have seen in Web3. We've seen the creation of lots of different types of businesses, many of them very novel. most of them associated with capital markets and the trading of some sort of instrument, um, but not really restricted to any particular sector or geography. And so I think that's super exciting. That continues to be my core thesis for the space. So I think there can be economic activity in Web3, and we're seeing a bunch of that. And then, of course, there's a whole financial sector that's grown up around the potential for economic activity, right? So anytime people launch a token that has the potential to represent something, some economic payload, whether that's a meme, which is a very short-lived economic payload, or whether that's a laundromat, or a tokenized hotel, or a U.S. Treasury. Those things have kind of a more robust economic payload, but again, like the architecture for dealing with it is the same in Web3. And so for me, I just see it as the place where digital GDP is going to grow. I think just to extend that out a little bit, not only will digital GDP grow there, but I think it's a place where we'll see artificial intelligence flourish, in particular economic artificial intelligence that's focused on making digital goods and services. So we can open up the topic in a bit, but that's where I spend most of my time.
Absolutely. And let's talk a little bit about generative ventures because you have the focus on AI, blockchain, on Deepins. Let's talk a little bit about why you selected those verticals, and then let's talk about some of the interesting things that are happening there. So let's start with why you selected those verticals.
Yeah, I mean, as I mentioned, I spent my career in finance and fintech, and then DeFi, and being really excited about DeFi as a sector, thinking that we could kind of ingest a whole bunch of Wall Street, and that proved to be really difficult. Like in the beginning, it was called security tokens. Most people probably won't remember 2018, but it was the idea of, can you put equities on chain? And then it was called tokenization, and then now it's called real world assets. But these are all just the same words for taking securities or investment instruments and putting them on chain. And you have these enormous markets, 30 trillion or 50 trillion for equities, another 100 trillion for real estate, another 60 or 80 trillion for fixed income. So giant markets. And that's really appealing from the crypto side to be like, okay, let's pull that in. The challenge is that you're trying to change the world that has been by converting it into the new thing, rather than creating the new thing from scratch. So if you think about the internet, like nobody set out to build the internet by saying the internet's going to be amazing if we just take all these books and we scan them and we link all the books that we scanned. That's a stupid idea. The internet is built by creating content de novo in the native language of the new platform, right? So websites, blogs, user-generated video content, all of that stuff. That was built on the medium of the internet as it came about. So Amazon or Google are much more interesting. Amazon's more interesting than Walmart for e-commerce. Digitizing Walmart's cool, but building Amazon is cooler. Google is a more interesting business than taking Barnes and Noble and putting it online. And so my interest now for crypto is, what is the native version of its GDP? What's going to happen that is going to grow out of crypto with, in its native system, rather than externally relying on somebody else? And that lands me into these categories. I think that generative AI is a huge productivity booster, and the only thing it can make are digital objects. Digital objects need to be owned, to transacted, protected, traded, monetized, etc. There's an obvious answer that blockchain does this for them. For Deepin, what I like about it is taking the physical world and creating the digital twin. Has been a theme for about a decade with IoT, and now we can bootstrap this digitization of the physical world. And it's also a bit harder to manipulate the metrics. So if you've got 100,000 robots or machines or charging stations attached to a network, then you have 100,000 machines attached to a network. Whereas with user numbers, I feel like, and volume and other metrics on chain, like those have been so growth hacked as to be completely unreliable. Like if I come across a project that's got 5,000 followers on Twitter, I will trust it much more if I come across a project that has 500,000 followers on Twitter, because of this like adverse selection of like bots and growth hacking that have infected a lot of Web3. So for me, like AI, Deepin, and these ideas around like economic growth rather than just pure financialization have been really interesting. And I think if that doesn't work, I think crypto overall is in quite a bit of trouble.
Yeah, absolutely. I definitely agree with that. Are there specific areas in, let's say, like the AI ecosystem? Because some people, even though we do a lot of decentralized AI episodes, they may come off as skeptical. They might be like, okay, blockchain plus AI just equals buzzword plus buzzword. So talk to us a little bit about
Sure.
like some of the things that are actually going on in the space that people can be like, maybe like AI smart agents, or talk to us what you're seeing that's really innovative in that space.
I think innovative may be the wrong rubric. I think what we're seeing is kind of the recreation of the AI value chain in a decentralized context. So, there's the robot body, which is the giant GPU farms. So we have lots of projects with its Render, Akash, and so on, um, that are trying to do a decentralized GPU data farm. Now, we invested in a company called Exhibits, and one of the things that we like about Exhibits is that they actually provide the servers to many of the decentralized GPU projects. So it all ends up on a computer somewhere. You know, how decentralized it is actually quite questionable. But I think you can find places where the real activity is happening. Like, where does it actually land? And then once you've got the GPU network, you can kind of go one level up and say, okay, are there things that are happening around models? And models have their own value chain as well, right? You have to start with data, because the data sets are kind of key to creating and training and tuning new models. And so there are companies that are focused on collecting data, and a lot of that has kind of proof of work type dynamics, where you are data mining by running an extension on your computer or something like that. Um, is this data really necessary? Is it going to make you better models? I don't know. All I do know is that I see a lot of companies that are trying to do this, like data collection, data tagging, and so on. There's not a lot of core AI model innovation in blockchain, and it is a different discipline. So we haven't come across people really building out, big new open source models, often because they don't have the funding or the skill set. We have come across ideas of using crypto economics to incentivize people to contribute knowledge to training models or to fine tuning models. Um, I'm somewhat skeptical of that, but certainly a lot of people are trying. And then, so then you get to a place of, okay, you've got a bunch of um, approaches to creating a model, and then that model needs to generate inference, right, and be useful somewhere. Um, and here, crypto's created pretty complex like structures to try and incentivize both bootstrapping the model networks as well as bootstrapping usage and demand. So you've got things like BitTensor, of course, which is like an incentive network to get people to provide models, to do the supply of models. You've got things like Morpheus or GaiaNet, or Aura or Zero Gravity. There's Aether. There's like a whole bunch of these things, which are kind of these hyperstructures, like large structures, which are meant to deliver inference. The product is kind of equivalent to getting an API from ChatGPT, at this point, at least, except the models will be open source, and so they will not track you. Um, they will keep your information private, and they will, generally speaking, not censor themselves. So you end up having a bit more kind of flexibility and privacy. An example would be Venice. Venice is a UI that sits on top of Morpheus. Morpheus is like an incentive network for people to plug in and provide inference. Um, it all feels very engineered rather than kind of demand driven at this stage. And I do think it's going to be tough for a while for crypto to provide like a value proposition um, in that space. But then you can kind of zoom out further and get to a place where, okay, so you have ways to generate inference. Can we plug that intelligence into something that's useful and different? And that's where you get into the AI agent space, where um, you would own software robots that do things on your behalf. And today, I think Autonomous is probably the best example of like functional AI agents on chain. They're a meaningful portion of the Gnosis chain transactions. And they do things like trade on your behalf, or they do predictions of prices. They can vote on your behalf in DAOs. So they do add some value, and then they're able to call off-chain inference to perform these tasks. Like they do make a judgment call. And so it's possible that decentralized AI that runs on decentralized GPU plugs into these agents and then performs economic actions. I think it's very early days. And then, of course, there's a whole slew of services and products around it. So we're particularly interested in the financial layer of crypto as it relates to AI, because that's historically the only thing that crypto's been good at. And so I think that whether or not AI itself is going to be decentralized, I think there's lots of places where the Web3 financial infrastructure could be the backbone for its economic activity. And so things like agent payments we really like, and we're looking at ownership of AI agents, permissioning, like things like that are of interest. But this is a space that's very early on, so we're sifting through a lot of stuff trying to figure it out.
Yeah, definitely mentioned some friends of the pod. I recommend people go check out the Morpheus episode. We've got the Venice episode dropping soon. Talk to us a little bit about your venture studio. What would you call it? A venture capital studio? Talk to us a little bit about Generative Ventures.
Sure, it's pretty straightforward. We're an early stage venture fund. We cut checks into companies. We kind of have two tracks. Either we'll lead and we'll do something like 500K to 1.5 million into a round, or we also have a strategy we call the Foundation Series, where we do small checks into an ecosystem, and that's partly because we think this space really needs to come together more as an ecosystem, rather than like a fog of independent players that don't integrate and on their own don't have enough usage to really survive. So it's quite confusing from where I sit, because we'll come across companies that'll have like 2 million users for a clone of character AI, where it's like just people talking to anime avatars all day long. And then we'll go to really kind of sophisticated on-chain agents, or like AI integrated into like trading stuff and so on. And it will have 500 users, and we'll think it's a really good product, but there's nobody there really picking it up. And then you'll have traction where people are playing the points game or the farming game, and they'll be deploying nodes just so they can farm the AI Deepin token, right? Of scraping data or providing some functionality of their computer, and so you'll have projects that are showing up with like 100,000 nodes, but really the node is just somebody agreeing to get token rewards, or like people will show up with the click farm games on Telegram, and it'll be like a 500,000 user footprint. And then you'll be like, cool, what does your AI agent on Telegram do? And the answer is like, well, if you click the button on the thing, it puts you into a lottery to win a Bitcoin. So it's like profoundly depressing and impossible to parse through a lot of this stuff. Um, I think we want to make a difference by bringing real economic activity on chain. Um, but it's also like a really loud moment, which I think which is super exciting because there's so many companies doing cool things. But for whoever is building companies in the space, I just hope that like you behave responsibly and you make real stuff.
Yeah, I think there's a common issue in the blockchain space is you might hear a common critique is blockchain is a solution in search of a problem. So you'll see like people like farm airdrops because there's token incentives, but my mom never goes to a website and she's like, oh wow, this runs MongoDB. Like the solution we build just has to be better, or like they can't. I think in the future, and this is why I'm bullish on a bit of the Ton ecosystem, is like, all right, now there's a bunch of wallets, and as long as it feels like a Web2 wallet and smells like a Web2 wallet, but is Web3 under the hood, like that to me is good enough. And I feel like user experience is really lacking in the Web3 space. I don't know how you personally see that.
I think it's a mix of that and generational turnover. Um, like I'd say a year, maybe 2 years ago, like smart accounts were really exciting, or like wallet as a service was really exciting. At ConsenSys, we did a bunch of this for big brands and media, where we launched a network called Palm, and Palm did the Damien Hirst drop, and then did a whole bunch of stuff with DC Comics, and like did big distributions of NFTs and so on. And the wallet was very abstracted away into kind of like an experience in your settings, in your user settings. And it's not that it didn't make a difference, but it it's not the reason anybody would care, right? Like nobody's going to care because your wallet is abstracted away. Um, they're going to join your app because your app does something novel or delivers an experience that's like satisfying or cool or viral, right? Like if Jimmy Fallon is shilling Bored Apes, then it's going to have a cultural moment. It doesn't matter how hard or easy it is to onboard. And right now, like even people love giving MetaMask a hard time. What people don't realize is MetaMask is primarily a wallet for developers, so that developers can integrate their apps into the wallet, and it can work. So the fact that you can use MetaMask and show up to any app on like a million blockchains is incredible, right? It's not phantom like going to Solana and turning that on. It's like pretty much every EVM chain. Um, and then on top of that, it's got integration into Solana, and then it can plug into Bitcoin. Um, and the other thing about MetaMask is the security. So like the number one service of a wallet is actually security, not UX, not ease of use, but security. I think Coinbase is doing fantastic stuff there. Anyway, the whole point of that is like today's onboarding experience compared to 2017, like CryptoKitties, is a million times better. A million times better. So I think I don't think that's the but for reason like things aren't quote unquote catching on. I think we're like over the UX hurdle, and generationally, like it'll just be more and more native to people. So I'm less worried about that user experience. What I am worried about is like how easy it is to get hacked and how to get your stuff stolen, and the sort of like dog eat dog world of I guess crypto traders or just like crypto users, and a lot of the sort of zero sum projects that we've seen in this cycle that are clearly like not going to create value long term, but are going to redistribute the pie in the short term. And so I think that's really damaging reputationally. Um, I don't have an answer. I think my view and my vision for Web3 is one where like you can make a living building products and storing them in Web3, selling them in Web3 native rails, and then taking your salary in USDC, having a storefront in a stable coin, being able to use Aave as your bank, being able to use Uniswap when you want to do asset allocation, and then being able to participate in different like collectives and affinity groups and DAOs and governance and so on, right? Like the Web3 I want looks like that. And I'm not 100% sure it's going to end up that way. Like there's definitely a path where it remains the casino, and it remains like a cynical casino. So I guess with a fund, what we're trying to do is try to select for projects that have a shot at making that first vision possible.
Absolutely. And it's a bit like the Wild West out there is you'll like I've even gotten people send me fake Zoom links and try to download like malware. Like the security issue is a really big obstacle that Web3. But I kind of look at it like early days of the internet, and I know this is kind of an overused analogy, but back in the day, you could just go to a website and just get a virus. Nowadays, that's relatively unheard of. Like maybe there are like sneaky viruses that people don't know about, but you don't just like go to a normal looking website and just like, oh hey, now I have like my computer has horrible malware that I need to hide from my family
Yeah,
and somehow debug.
yeah, I think it's worse actually than the early days. I remember the early days of the internet, and I was downloading a lot of like low quality software. Like
Yeah.
I was using Napster on the day Metallica was like suing everyone, and Napster was going to get shut down, I think, on a Wednesday, and I like stayed up Tuesday night to like download as many Metallica songs to like show them. Um, so yeah, there's a lot of there was a lot of dangerous things you could do, and like putting your credit card into a website in 2001 felt dangerous, but I don't think that it was as bad because crypto is inherently financial. So on the internet of media, like, yeah, you could blow up your computer, you could lose your information because that's what was at stake. Now it is immediately like your assets that are at stake. So, imagine how scared you would be of losing access to your Gmail so that everyone can log into your bank accounts from your Gmail. Like, it's over. With crypto, it's immediately your bank account. So I think that, for the internet, you have tools like every computer comes pre-installed with virus protection, right? And then every website is now HTTPS instead of HTTP. And so SSL certificates like are a requirement for you to be on the internet. And if you don't have one, like people will be blocked from actually accessing your website. I think in crypto, we still lack a lot of that. And I don't know if it's a standards body that's necessary, which is, I think, really hard when you have such brutal competition between chains just for attention. Like the pie is not growing fast enough for everyone to pause and start doing standards work, and so you're still kind of fighting over the demand and lowering the barrier to entry, which exposes people to lots of risks. And I think the whole pleasure of crypto is the risk for sure, but there are just like net bad experiences you can give to people, and
Yeah.
then you kind of lose them forever.
Yeah, it's like bungee jumping could be very fun, right? But like if the cord started breaking all the time, people were getting like their lives taken, it would be less fun. Like we could have it be risky, but less risky would be my hope. So you meet with a lot of founders, you evaluate a lot of different companies. What do you think are some of the biggest challenges facing Web3 founders? Do you feel like it's marketing, fundraising, community engagement after they launch a token? Where do you see the issues?
That's an interesting question. The founders we meet are all really different, and by sector. So I feel like we have really fast thematic rotation in crypto, which makes it challenging to build for the long term. So like in traditional startup land, it'll take you 10 years to build a company. the first 2 years you're in the wilderness, you're trying stuff out. By year 3, maybe you have like a little bit of a product market fit. By year 4 and 5, like now you're making 10 to 20 million of revenue. By year 6, that 20 million turns into 100. By 7, 8, 9 is like you're a unicorn or not. And that's a real way to do things. I think in crypto, you have the present value of all possibilities in all of the multiverse timelines gets discounted to literally the moment somebody like launches a token. So the moment you have a thought, and then if the thought is viral, then it will be valued as if you had already achieved everything you've ever thought about, regardless of the fact that all you did was have a thought. And then people make the mistake of optimizing not just for narrative, but around the sort of financial infrastructure to have a good token launch. So because you can get away with it. There's an industry that funnel that's like investment banking for early stage ideas, right? And so centralized exchange listings and so on and so forth. And I think that ends up feeding back that the cycle for ideas is much shorter. So like we had like a mini boom and bust in Web3 AI that started November of last year and ended in May of this year. So what? Like it's over, like now we'll never use blockchain for AI-based productivity ever, because we had like a mini cycle and people are burnt out, and things went to 15 billion with BitTensor, now down to 5 billion, right? Like that's total nonsense. That volatility is completely meaningless. Like there's no information, there's nothing to deduce. I don't think it's like accelerated learning. I think it's like accelerated psychosis that is completely distracting. So I think it's difficult for founders to be long-term oriented around like actually solving a problem at a large scale. And maybe that's kind of that's probably one of the biggest issues, is the distraction of the primary capital markets for crypto. Everybody has to be a little degen, and you have to understand narrative, and you have to understand like token launch and managing that. But if that's the primary thing that you're focused on, and you're just like, what clothes can I put on my token, then I think these projects are dead in the water. On the other hand, like you do have constantly a flow of new ideas. So for example, right now we're seeing a lot of stablecoin ideas because Tether just printed 5 billion in profit last quarter, and that's a lot of profit that other companies want to fight for. And so the entrepreneurs that are going after that are going to be really different than rewind 3 years, all of the gaming companies that like wanted to do gaming on chain. So I don't think, like, I can't paint with one brush because the profiles are all so different. I would just say like it's striking the balance of understanding crypto, being crypto native, understanding sort of like the sacrifices and like the orientation that you need to have around community, around DevRel, around building for people an experience with your token, but then also being a complete financial nihilist is a non-starter. Like you're building a company or a project, it has to have fundamentals. If you think like you're too cool to have fundamentals because it's all memes, God bless, but that's, I don't think in 3 years any of those names are going to be around.
Yeah, absolutely. Now, you are in the venture space, and I'm not in the capital providing space, but I am very bearish on like early stage companies releasing tokens. Like back when I worked in startups, it was like, why would you wouldn't want to be public, because it's just a lot of scrutiny. There's a lot of like stakeholders, and there's just a lot of things that come with having some kind of publicly traded asset associated. Do you recommend, like, at what stage do you recommend people start thinking about a token? Do you recommend it at all? Like, what's your kind of opinion on these like early liquidity events?
It depends entirely on what it is that you're building. So ConsenSys, we used to have kind of a framework for it. The more the thing you're building is like a protocol, and the more mechanistic it is, like deterministic. Like if you're building a big math machine that needs a token to operate, God bless, right? So like Ethereum's ICO was before any sort of product market fit for Ethereum or for it as a project. Like it wouldn't make sense to do anything else. But that's because the whole thing is a giant math machine, and the token is part of its product for it to work in the first place. If you're like building a restaurant that, you know, with like a social DAO where like your DAO token can be staked on different parts of the menu, and then like you get royalties if people eat burgers, right? Which is like, I don't want to get upset, right? But like if that's what you're building, which is super cool, and you're using like crypto economic ideas in there, it's a restaurant. Like make the burgers. Like anyone want to go to your restaurant? Does your food taste bad? You know, it's like, oh, we'll tokenize the chairs, and then if you hold the chair for 4 years, then you get like another chair, but then we'll do like a derivative that we'll put the chairs into, and then we'll have liquid chair derivatives, and then like and just like, you deserve to die. Like your project should die because instead of making the burger, you were like writing derivative instruments on your restaurant chairs. Whereas at the protocol level, of course, right? But then everyone starts investing in infrastructure protocols, and you've got like this glut of layer 2s and like all layer 1s and so on. And so the market for protocols for like the math machines has also changed. So if you are yet another person building a giant math machine, you can't expect the same outcome as, you know, in prior cycles, because it's just a different environment. So I think it's really contextual. I think the tricky part is for things in the middle. So if you look at like the original DeFi protocols, right, that like functioned as applications or as platforms on top of blockchains, but then decided to launch tokens in order to do retention and to do another capital raise or whatever, I think those are more difficult. And that's where I think token design plays like a pretty heavy role, you know, and you can go all the way towards blast and blur, or you can go much more conservative. So I think there I'm in favor of flexibility and like using tokens to kind of achieve very specific goals.
Absolutely. Well, Lex, thank you so much for coming on the podcast. Finally, like, where can listeners learn more about you, what you're up to, hear more about your ideas? I know there's a newsletter, so shout out any kind of social media you have, anything people should subscribe to.
Cool. I'm easy to find, Lex Sokolin on Twitter. And if you are building a company in the space, check out GenVentures.xyz, Generative Ventures. I also write a newsletter focused on FinTech, which is called the FinTech Blueprint. And now I've just launched a newsletter on AI called the Future Blueprint, so that I can use the same logo as the one for FinTech. So yeah, don't hesitate to get in touch.